Faced with a black hole in public finances, the Labour government have announced an end to the universal winter fuel allowance. It will now be means tested, and it means that around 9.4 million pensioners will lose their £200 to £300 a year allowance. It will save the government an estimated £1.6 billion a year, which, as we shall see, is just a drop in the ocean compared to the government's £5 trillion worth of pension liabilities. Now, not all pensioners are poor. Around 50% of pensioners are in the top half of the income distribution. And those who own a house and who have paid off a mortgage have lower living costs than the average household. But there's a big problem with means testing. Firstly, many just miss out on the winter fuel allowance by just being the wrong side of a pension credit threshold. Current level is just £218 a week. So if you get £220 income, then you lose out on £200 a year. It also penalises those who save for private pensions or who work part-time to top up their income. Means testing can really give a sense of unfairness. If you save and work more, you lose out on benefits. And in the long term, it may reduce the incentive to save or for older people to work part-time. The second point is that many people who theoretically are eligible for pension credit don't claim it. An estimated 780,000 pensioners in England and Wales will miss out on winter fuel allowance because they don't apply for pension credit. In fact, if everybody applied for pension credit who are eligible, it would cost the government more than the savings of £1.6 billion in winter fuel allowances. But what it means though is that many vulnerable pensioners will miss out on winter fuel allowance and be pushed into fuel poverty. Now, the government point out that in April, the state pension is set to rise by £450 a year because of the pension triple lock guarantee. So even though winter fuel discount has been removed, there are a net increase in pension income. But there are three aspects which still make this unappealing. Firstly, behavioural economics shows that we budget spending. A winter fuel allowance helps people to have the confidence to properly heat their homes. Secondly, losing what we already have is always a big psychological loss. And also the rise in state pension is needed for all the other costs of living pressures which are going on in the country at the moment. So overall, the result has been a big political backlash, but the savings are relatively small compared to the overall spending and tax revenues of the government. Let's look at the big picture. In 2022-23, state pension spending was £126 billion. The next year that rose to £152 billion, and by 2028 it will reach £172 billion. And looking further into the future, the OBR claim that on current policy, government spending as a share of GDP is expected to rise from 42 to 59% by 2070. This is clearly unsustainable without some major change in policy. The problem is that the UK population is set to age. The share of the population over 65 is going to nearly double from 27% to 55% by the end of the century. Now, this forecast may be somewhat dubious. The ONS assumed zero migration for some reason. But there is definitely a very significant fall in fertility rates going on at the moment, much less young people coming into the workforce. And the result will be an unwelcome combination of rising government spending, but also diminishing tax revenue because people are paying less income tax, less national insurance. Now, an ageing population means more pensions, but that's not the end of the story. It will also mean more healthcare. And healthcare is forecast to rise to 13% of GDP. And to compound all these problems, as you have an ageing population, you tend to get lower productivity growth, lower economic growth. So you're unable to grow your way out of higher demand for spending, like we did in much of the post-war period. If we look at the past 10, 15 years, the UK economy has been really growing very slowly, per capita incomes barely increasing. And that will create a real fiscal squeeze because you rely on economic growth to get more tax revenue. And if that's not there, the budget pressures will be even greater. Now, there is one solution to this pension problem, and that is to raise the retirement age. In 1940, the retirement age was set at 60 for women, 65 for men. But over the next few decades, life expectancy rose really quite dramatically. And the cost of pensions rose because the pension age stayed the same. In fact, there's one study which suggests to make the UK pension sustainable in the long term, the pension age would have to rise to 71. Now, this is a neat solution in that it makes a big difference. For example, just delaying the pension age rising to 67 would cost more than £60 billion. And the argument is also that raising the retirement age could also increase labour market participation and higher economic growth. However, there's quite a lot of problems with this. Firstly, when we increased the pension age from 65 to 66, only 8% of that age cohort moved into paid work. Secondly, implementing a higher pension age can only be done very gradually, because if you plan to retire at say 67 and then suddenly it's increased to much higher, then that messes up your savings and pension plans. The IFS also found that raising the retirement age from 65 to 66 caused a 25% increase in poverty amongst those 65-year-olds. The reason for this is that there's currently a 100% gap between benefits you can claim when you're working age and those when you're of state pension age. In recent years, pension benefits have risen much faster than working age benefits. And I think it is fair to point out that pension benefits have a greater political visibility than working age benefits. But the other big problem with raising the retirement age is that the number of people over 65 reporting poor health or some form of disability has been rising. Only 10% of the population stay healthy into the over 70s. And this is the problem. The UK has seen a rise in poor health and a decline in healthy life expectancy, which makes it very difficult to countenance any significant increase in the retirement age. So although it's a neat economic solution, there's a lot of practical problems, and often it's the low-income households who have the hardest physical work, more likely to have ill health. So raising the retirement age almost certainly will cause an increase in old age poverty. But there's another coming economic crunch which will make energy bills pale into insignificance. The UK pension model is based on the assumption that pensioners will have low housing costs, either owner-occupied when you've paid off your mortgage or living in subsidised social housing. But the new reality of the UK housing market is that future generations are increasingly in the privately rented sector. And this presents a real dilemma, because when you reach retirement age, it means if you're still paying a market rent of, say, £1,200 a month more in places like London, then it is going to dwarf the state pension income. It means the government will need to significantly increase housing benefits just to avoid the pensioner age group becoming homeless. And one solution there is to build more housing specifically for the needs of pensioners and people living alone. How has the triple lock guarantee affected pensioners? Well, there is some good news on this. Since 2005, pension income has risen relative to average working age households. Now, this reflects more a stagnation in average wages rather than a massive increase in the pension. But the share of retired people living in poverty has also declined. It was once the most at-risk group, but this has fallen. And this is due to the fact that the triple lock pension guarantee has often meant the pension has been able to rise more than, say, inflation, or more even than real wages. In the past 14 years, pension incomes rose 9%, non-pension incomes rose by 5.5%. But does this all mean that the UK pension is generous, overly generous? Well, let's compare it to other countries. Because the UK actually spend quite a low share of GDP, just 5% on pensions, compared to say 16% in Italy. The pension replacement ratio is also relatively low, around 50%. What this means is that average pension income is 50% of the value of average earnings. So it means that when you retire in the UK, you have a big drop in income. And this is a big deal, especially if you've got high housing costs and high energy costs, which we've seen in recent years. The removal of winter fuel allowances was a poor decision. It negatively affects many relatively low-income pensioners who just miss out on pension credit. It's also been very politically costly, whilst at the same time saving relatively little money anyway. A better solution would have been to be more like child benefit, where everybody continues to get the benefit, but you claw a little bit more back from higher income tax on high-income pensioners. But given the long-term projections for pension and government spending, something does need to change more than just taking away winter fuel allowances. But when the main political parties always seem to rule out any major tax rises, it's going to be very difficult to raise the kind of funds that the projections say is going to occur. For example, if we wanted to raise more money, a 1p on the VAT rate from 20 to 21% would raise in the region of £7 billion, and that's a significant contribution. And raising VAT by 1p would probably be less politically costly than taking away £7 billion worth of benefits that are already there. The uncomfortable truth is if we want to maintain a decent state pension and avoid massively increasing the retirement age, which has many problems, you are probably looking at some form of increase in the tax burden more than what has already happened. Now, the alternative is to just increase debt, which has already increased quite a lot already, or privatisation of some public services. Also, another alternative is that it's not particularly easy, but if you don't like the idea of higher VAT or cutting winter fuel allowance, there are ways to try and tax the rich and high income earners, which this video goes into. So do check it out, it's worth seeing.